Okay, everyone. Welcome back to the channel, Matt with Green Bar Trading. And in this video, I'm going to go over what we saw today with the PCE index. This is a favorite of the Fed. The Fed likes to look at this report more than any other report. So, with that much riding on a report like this, if we get numbers, which we did, that did not line up with inflation coming down, we were going to see the market pull back. And that's exactly what we saw. We saw a very hot inflation report. And we have been seeing very strong labor markets, and we've been seeing a lot of consumer spending, right? The retail sales from last week blew it out of the water. We have just been seeing a lot of very strong economy and strong demand, a strong consumer. But all of that, while it's great for the economy and it's great for business, it pushes prices up. The Fed wants that to stop. That causes inflation. When prices keep going up, that's inflation. All right. It's not good for the long haul. It might be good for profits right now, but it's not good and it's not sustainable for an economy to run this hot. So, I'll go over the report here in a little bit and the market reaction to that. Before we do that, hit the thumbs up for the video. If you are new, consider subscribing to the channel. If you learn something, if you find this information valuable. So anyway, let's get into it. We're going to go over here. This is the economic calendar. By the way, the economic calendar is so important, especially in 2023. The market moves on every one of these reports now more than I have ever seen, because so much, like I said, is riding on the Fed and the numbers that come out and what they may do as far as raising those interest rates, which when they raise the rates, it's not good for the people, right? You're paying more. Your credit cards, your car payments, your mortgage, you're just paying more for everything. So that's what we saw here today. We saw the core PCE, and I'm going to go over what the PCE is, but we saw it come in at 0.6%. The estimates were for 0.5%. All right, so that is not good. We want to see beats in this. We want to see the inflation beating the previous month and beating estimates, and it did not do that. This was the highest reading since last October. It's not good. That's not good. That's month over month, and that's not a good number. So the core PCE year over year, 4.7. PCE headline numbers, 5.4. All right. So what the Fed looks at, it looks at this core PCE, which is at 4.7. It wants to see that get down to about 2%. We can't get there if we're missing estimates, right? If we're going up from previous months, that's not good. They're going to need to raise rates more than even expected, priced into the market. And when we see that, you can see the market can re-rate everything and come on down. We can see the bond yields spike up, and that's exactly what happened. So what is the PCE? Well, the PCE price index, released each month in the Personal Income and Outlays report, reflects changes in the prices of goods and services purchased by consumers in the United States. Okay? Right down here. It's a measure of prices that people living in the United States or those buying on their behalf pay for goods and services. The PCE price index is known for capturing inflation or deflation across a wide range of consumer expenses and reflecting changes in consumer behavior. That is why the Fed likes this report as a gauge for the consumer, for the real average person spending on those consumer prices of goods and services. All right. That's why it's so important. And you can see here, January came in at 5.4%. And those month over months were just not good at all. You look at the current release, this dives into it. You can see here, we like to look at the core PCE because that excludes food and energy. And that was up 0.6%. Like I said, this was a very, very hot number. This was not good for the markets. And we saw that, especially in the bond yields. So the bonds sold off, the yields rose. When that happens, the market sells off. And that's what we had today. So when you see these yields go up, that means that the bond market is starting to price in a more hawkish Fed, that they're going to have to raise rates higher. That's why these yields go up, because they were not pricing in what was currently in the market. So then that's what happens, and the bond yields have to really move quickly because they got new information. That inflation report was not good. So they're starting to hear the Fed talk about maybe even a 50 basis point move in the next meeting, when 25 basis points was already priced into the market. So with more rate raises than expected, you will see the market sell off. That's what we saw today. Now, going to the charts, the SPY. Let's look at this one on the 5 minute, just so we could see what happened in the pre-market. Now, the last 5 trading days, we've been making a series of lower highs and lower lows, very, very clear. Today, we got that report at 8:30. The market sold off immediately, and that's not surprising after a report like that. All right, and then it just continued to trade on sideways. So this was not a good day. The S&P 500 was down over 1%, even though it traded off of its lows. This has been happening the whole year. We've seen these V's, right? These V's. So you get a sell-off, comes back to basically where it sold off from. And we've been seeing a lot of this. Today was nothing different. We opened up, sold off, came right back. 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 That's called a choppy trading day. Right here, what you see is not easy to trade. It's simply not easy to trade. So why was this resistance? Well, that was the 50-day moving average. That's also why I believe we saw a lot of volume yesterday off of this level, that 50-day moving average on the daily chart, and saw that nice rally into the close. Couldn't hold it, sold off under it, and then that 50 was then resistance. All right, that 50-day moving average is a very important level on the daily chart. So where are we now on the SPY? I am not surprised at all that this is where we are. In our weekly watch list video, I literally called this out, that we would come down here and test this area, this point of control. But right now we're over the 200 moving average. We're still over this trend line that I have here from October. So this is going to be a very important point right here. So, if anybody was swinging calls, I actually would not think that was that bad of an idea, because I think you're going to see either a bounce here, right? You got the trend line coming up, you got the point of control, big volume ledge, a lot of support here. What is resistance, right? Ends up then turning into support. So I think we can possibly see something like that. If this breaks, then all bets are off. You're coming back down, you're retesting at least where we started the year. But right now, This is a good spot, I believe, to possibly get long the SPY. That's what we saw today. We saw the sell-off. We saw a little bounce off the lows at that point of control, 200 moving average. This trend line was support, and we'll just have to wait and see for next week. Hope you guys enjoyed this video. If you did, hit that thumbs up, and I'll see you on the next one. Take care.